You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it is time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever exciting Options Insider Radio Network. No shortage of outlets where you could find all that great Volatility Views content, well over 100 hours worth of vol views alone there on the network. And you can find it all starting at our course, the mothership, the flagship, the Options. Don't forget the Insider.com. You can read all the great content there, articles, analysis, unusual activity, breaking news. You want to listen to some audio? We got you covered. Click on the Insider Radio Network tab, and it's all there for your listening pleasure. We even tweaked it a little bit recently, made it even easier for you to subscribe to some of our programs in some of the other platforms I know a lot of you guys like to use, like iTunes and Stitcher and TuneIn and all that fun stuff. I did see recently they're also bringing Spotify online for podcasts. I know a lot of you guys like to use that for music streaming, so we'll see about getting our stuff up there as well, so you guys don't even have to change apps. You can just keep all in the same app, and when you're tired of streaming music, you can jump on over to our stuff, and it'll be seamless. And of course, if you don't mind changing apps, then of course, we have an app for you available in the iOS, Android, and Amazon app stores. And joining me on the old program today, my volatility compatriot, my partner in crime, the dark side to my light side, the Greasy Meatball himself, Mr. Mark Sebastian from OptionPit.com. Mr. Greasy Meatball, welcome back to the program, sir.
Hey, good to see you, Mark. How's everything going?
Sounding pretty good, sir. What are you using today?
I'm using a microphone and earphones.
Well, that'll do.
It's a good combo.
I think it's because you're on a mobile device all the time or something like that.
No, I'm not on a mobile device now. I'm actually on like a regular
Exactly. That's why you sound better. There you go. I like it.
So I'm not on Aha Mobile, which is usually where I broadcast from.
You'd be surprised how many people love the Aha. They can use it in the car. Of course, now that there's CarPlay and all that Android Auto stuff, they can use that now too. So no shortage of ways to get us.
Did you say CarPlay or cosplay? Because I'm not sure.
Both. I like to do both. But
yeah, you like
right now I'm standing here in my Mighty Thor costume as we're doing the show. Because,
nice.
You know, it's radio, so you can get away with that kind of stuff. All right. And with the team assembled and the nonsense already underway, let's dive right on into the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. You know what this segment is all about. It's time for us to break down the week that was from a volatility trading and analysis perspective. We are recording this on Friday, May 22nd, for all of you playing the home game, right heading into the start of a long holiday weekend here in the States. So if all of you guys are trading domestically, then of course, we got a long weekend ahead of us. Even if you're overseas, hey, enjoy the nice long weekend. Take it off. It's fun. But of course, whenever we have a scenario like that, of course, the question arises very quickly during the week of, hey, when are they going to take the weekend out? When are they going to take the weekend out? And certainly, as we're looking at it today, they were not hesitant at all this week. There were no big events coming up on Thursday or Friday that really seemed to give anyone any reason to have any pause. They started crushing the vol yesterday, and even today, as we are relatively unched on most of the major indices. S&P almost literally unched on the day. NASDAQ and the Dow pretty much almost literally unched as well, yet they're still squeezing that vol a little bit. The vol implosion started yesterday, the vol crush, and continuing into today. We'll see as the day progresses if they continue to squeeze more out. But at this point, they're getting fairly aggressive with it. I don't know how much more I'd be willing to crush. But let's get into that, Mr. Sebastian. What's your opinion on them clearly not being very reticent to smack around some vol going into the weekend, as well as what else caught your eye in the week that was from a volatility trading perspective?
I mean, they really just took this stuff down. We crossed that 2020 level and have really not looked back since, but haven't really moved that far. It looks like the market's in kind of slow climb mode, and volatility is paying the price for that. The only area where it's still kind of elevated is in the oil market, where we're still seeing the OVX and into the 30s, but that's going to change soon, and a little bit in the currency market, but TY VIX is the one that I've been trying to kind of keep an eye on, because that's one where I think we may see some action here, because clearly the bond market is moving around. No issues for that. So that's an interesting thing to kind of keep an eye on is how that sucker is moving around. And because we've seen bonds, if there's been any volatility, it's been in the bond market.
Bonds have been one of the few hallmarks for volatility traders and watchers of late, because there hasn't been a hell of a lot else to really hold them out this week. It seems like everybody kind of waited for the Fed from an equity perspective this week, equity vol perspective this week, see what the Fed had on. We actually saw some interesting positioning in the euro-dollar options to the downside immediately ahead of the Fed. I think about 80, 90,000 July puts going up out there. So some pretty aggressive positioning right ahead of the big Fed announcement this week. I don't think that worked out too well for them. Again, it was July, so they got a little bit of time for that to work out. But it seems like after that Fed, the Fed minutes came out, the Fed numbers, that was pretty much it. That was pretty much all anybody was waiting for. The rest of the week, we had some earnings. We had, Best Buy and a few others, but nothing is really going to keep, certainly nothing like a non-farms that would keep people even contemplating selling vol at this point. Going into this weekend, they decided, the heck with it. And here we are looking at right now as we're recording this, listeners, VIX Cash south of the 12 handle, hovering right around 1190 or so. So we're getting into that range, and even at those levels, and we'll get to that in a second, how low is VIX, how low can it go, but of course, even at those levels, we're still looking at a 30-day realized out there in the S&P of about a 10, and a 60-day realized of about an 11, so you could say, 1190 or so, given the 30-day prognostication, is not aggressive. I certainly would not be running into to dump and carve that out and try to harvest some premium ahead of the week. I'm not even actually looking at these levels. You talked about it before. But this may be a good opportunity again. Start looking at maybe buying some premium, get a free weekend out of it. See, who knows what could happen this weekend. At the very least, I think you won't be too hurt come the decay, come flooding back in on actually Tuesday morning of this next week. Looking also out there in VVIX land, a name we've talked about a lot and we watch quite a bit. It has been rocking and rolling of late. Not so much this week. It hasn't really been a big rock and roll week from a VVIX perspective. We're trading kind of on the lower end of that recent range. Remember, listeners, that has spiked up into the 80s and almost into the 90s, and several actually did hit into the mid-90s at one point. So it was rocking and rolling there for a few months back. Coming off that now, trading right around 74.5 or so. So still fairly volatile, but certainly not the explosion that it had been of late. So a lot of things kind of conspiring to people out there who are just looking at the numbers and saying, you know what, I don't want to carry my vol through this weekend. And they started dumping it yesterday, and they're still dumping it today. So that seems like that's going to be the narrative of the week. Since we're hitting on it, Mark, let's just get into it now. The drum beats have already started. We hit on this a few months back when it started hitting into the 14 handle, people were beating that drum of, oh, geez, VIX is too low. How low can VIX go? Well, we're seeing that again. In fact, quite literally, I think it was Barron's the other day. I don't know, it was Wall Street Journal. I correct myself, who had a blog post of literally the title was, how low can the VIX go? So we're back in that range again, and they were thrown around. I guess once the VIX starts getting in the 12 handle range, that's when these articles and this discussion starts taking over the dialogue. They were talking about it's within striking distance of the 2015 closing low of 12.29. Of course, we have since broken that. We are south of that today. They're talking about the lowest it hit recently last year was 10.32 in July of last year. We're still a bit of a ways from that, but still that was the lowest close that had hit since 2007. They're also bringing back some historic numbers here, talking about the lowest close on record. I put that on record in quotes because there was no VIX in 1993. This is all historical data. But back in December of 93, they marked it at a 9.31. So they're already starting to bandy about these crazy numbers here, Mark. What do you think? You think we're in that? Is this going to be our fate for the rest of the summer? Is wringing our hands over how low can the VIX go? And then, of course, seeing the resulting articles of, hey, you got to load up here because this is mean reverting and it's going to gap back to its long-term average of 20 any day now.
Yeah, well, I do think that we could see VIX get a little lower. I think, the one thing that's been interesting is that I think people are finally realizing where the Fed kind of stands and what isn't happening in the next few months, which I think clears the way for volatility to drop some more. The one thing I would keep an eye on is the spread between, this was a piece out of the RMC. Down at these levels, keep an eye on the spread on kind of average equity volatility in the S&P 500 versus SPX. Because at these extremes is when that type of trade develops where, at the money and near the money volatility for equities gets cheaper than actually SPX volatility, creating some dispersion or at least some sort of ability to hedge using baskets as opposed to straight SPX options. So that's something to keep an eye on. And yeah, we're sitting here looking at an 11 handle in VIX, and I don't know that we're going to hit last year's low, but would not be shocked to see a 10 handle sometime here in early June, maybe right after non-farms before the Fed meeting. It's just kind of interesting to see how everything lines up. I don't know that I would want to buy volatility here. Now, one thing to remember with the VIX, we've got a long weekend. We're going to come in on Monday, and it's going to be 13. But the interesting thing is it's not just the VIX. Look at the VIX future. The June future is 14.3. When was the last time we saw a future with, close to a month to go trading closer to a 14 handle than a 15 handle?
I was just starting to dig that up. It's been quite a while.
It's been a while. I can't really recall seeing any of the past ones. So if I pull up a chart of the May future was above, didn't really break 14 until April 24th. So it took a little while longer to get that spread. So definitely kind of an interesting thing to be watching, and I'm really surprised that they've taken the future down the way they have, and it implies that maybe we come back and the VIX isn't up that much. That's kind of the way it lines up, right?
So we're not going to get that Tuesday morning pop.
Maybe not. I mean, otherwise, I don't think the June future is trading 14.25. Do you?
So that makes the scoop going into the weekend a lot less attractive.
Indeed. Although, who knows? Maybe the future's a little oversold into the weekend, too.
I would probably lean more that way. People are just hitting everything right now. They're kind of indiscriminate. Yeah. We've seen this before. Hit it all. They don't care. Past is not prologue when it comes to volatility selling, apparently, which is interesting stuff. Of course, the one thing, everything else is down. A good point about the dispersion opportunities, I think, now, too. I think that is something that's starting to line up. I think a lot of people who look at this space, that probably wouldn't strike them as surprising, given the fact that SPX, kind of its own tradable beast, has its own kind of life, independent of those aggregate baskets. So if you have access to those baskets, and you can kind of put them on in some favorable ratios, and maybe some time to start looking at that kind of thing. Make your own S&P, build your own DIY, as they like to say, in the tech space, and then sling against some SPX, take advantage of all the fun stuff. Speaking of things taking advantage of, we're talking about everything that was down this week. Vol was down, everything's down. One thing that wasn't down, has been down a lot lately, was not down this week, was out in VIX land, VIX Options land. This was the week of roaring back to life, I guess you could call it. Of course, a lot of that driven by the expiration and settlement out there. People were just lighting it up out. This is the product we were saying recently used to light it up, used to do 700,000 to 1 million contracts, no problem a day. Of late, a lot of people have been analyzing why this is the case. We've talked about it a lot here as well. Of course, volume down precipitously in Q1, now coming into Q2, struggling to make 250, 300, 400,000 contracts a day, a lot of days. So this week, blowing the doors off at 700,000 on Wednesday, 750 on Tuesday, 945,000 on Monday. A little bit weaker day on Thursday, about 350,000, again, showing how expiration and settlement were really driving a lot of that paper. But still, this is one of the more robust volume weeks we've seen in some time. That kind of one aberrant 1 million contract trade notwithstanding. You pull that out, and there wasn't anything going on in the last few weeks. I'm trying to remember in recent settlements and expiration cycles, I don't think we've seen this much paper rolling into and out of the cycle as well as we did this month, Mark. Maybe you've seen something different than I have, but it seems like this was a more robust cycle than last from a closing and then re-rolling. We saw people diving in to June upside post X, really trying to looks like reestablish those hedges and those specs to the upside. Over 250,000 June upside calls going up like immediately after the expiration, kind of just to reestablish that upside. So it seems like people are flocking back in, almost in more size than we've seen lately. Did it strike you that way as well, Mark? Was this kind of a busier expiration settlement week than you've seen in recent past?
It was, and now, because I think a lot of people are looking at where VIX is and where the June future is and doing a cost-benefit analysis and saying, this is something that maybe it is a little cheaper to hedge in the non-correlated market. I want to buy something that's going to give me help quicker rather than, because the market, they're stuck between a rock and a hard place. You hedge in VIX. If you want a consistent hedge in VIX, you either come up with a clever way of hedging like our back spreader friend, or you deal with some contango. The alternative is you buy some put in the SPX and then watch the SPX run 300 handles from your hedge, and now your hedge is basically worthless. So I think people are looking at the SPX and its ability to potentially run and kind of the relatively low VIX levels, and basically doing the math and saying, hey, VIX is probably worth having the hedge on rather than in the big cash. Could also be some over-the-counter trading going on as well. But, yeah, volume is robust. Here it's a slow day and a long weekend, and we have 2 hours to go to close a business in VIX, and it's already done more than its average daily volume today.
Yeah, you're right. It's lighting it up, closing in on 500,000 contracts already
90,000
today.
of the June 18 calls. 105,000 of them have been traded today. You got June 18 calls lighting it up, and the 16-20 call spread as well, plus some August today. So all call buying. You know what the call to put ratio today is 5-1.
Yeah,
that's nice.
We're getting back into that range. We used to joke on the show when it got really heavy for a while there, getting like the 4.5 to 1, sometimes some higher range in the open interest, not just in the daily volume. These days in the open interest, we're seeing about 2.5 or so to 1 calls over puts, which is pretty much about historically where VIX likes to hover in that range. But today, of course, 5-1. That'll of course skew those numbers a little bit going forward. I was just looking, Mark, while we were talking to see how our friend there on that massive 1x3. Remember, listeners, he rolled to July. It was the 1723 1x3, where he sold 1, bought 3, and interesting how that one's playing out for him here. Again, we also speculate, of course, what else he had on OTC. He had something else aggressively, but we were talking about how he would need to really scramble to hedge if indeed VIX did start breaking up to the near-term upside. Clearly not concerned about that right now, so he had some decent timing on that perspective. Let's move on to some other products that are also doing some surprising volume, at least to me, Mark, maybe not to you, but it certainly surprised me. Listeners, if you caught our last episode we had the return of the great Don Schlesinger, which was always fun. And we spent a lot of time discussing and debating the intricacies of the new AccuShares VIX Up and VIX Down ETF products. These are the products that were put out there by Whaley, ostensibly to solve the contango issue with the VXX and other ETFs. They seem to have post-release or pre-release kind of shifted their focus and now saying, no, forget about that. We're going to instead deliver the spot VIX. And we talked a lot about how, on the last episode, some of the questions we had with this product, the way it was conceived, the way it was constructed, the costs involved, the fact that they had to have paired trades on both sides of it. So what happens when you have an extreme movement in one direction? A lot of things that seem to raise a lot of questions. Of course, would they be able to actually deliver what they were talking about, the spot VIX? Well, apparently no one listened to that show last week, Mark. Either that or they listened to it and then decided to go out and trade it anyway, because this thing was lighting it up this week. Certainly not volume numbers that surprised me. They saw coming in on Wednesday doing 70,000 shares in the VIX Up and about, I think, 36,000 or so, 22,000 in the VIX Down, and or about 30,000. And then on Thursday, about 36,000 in the VIX Up and about a similar amount there in the VIX Down. So a robust amount of volume, 70,000, and 91,000 on Thursday in the VIX Up. So just a ton of paper. Did that surprise you? I mean, clearly they've been doing a lot of media for this product. They've been beating the drum for it a lot. And usually we see a spike maybe one day and it kind of goes away. But at least for this week so far, a few days in, they seem to be doing decent numbers.
Yeah, I was a little surprised. Yeah, they're doing 70,000 today. And I'm a little surprised. But, you know, what's interesting is that basically this is trading exactly like a VIX future. And the premiums, like it's... The people, if you go out on the web, people have basically quantified this to how it's trading again relative to a VIX future, and it's been tracking it pretty closely. So, you know, if there's one service these guys came up with, is maybe they came up with a tradable, consistent VIX futures ETF that that people can trade month over month without having to trade some silly, illiquid ETF on some. VIX July or VIX whatever. So, they don't have what they were looking for. They're much like a U2 song. They still haven't found what they're looking for, but they did find something. I think that's kind of what we've come up with. This is going to act a lot like a front month VIX future. And that's the way it's going to trade.
Well, if they can deliver on that, I mean, it's not really what they were talking about to begin with, but if they can deliver on that, it's kind of been the holy grail for a long time. People trying to find some way to deliver futures products and futures types performance to the overwhelming number of people out there who primarily have securities accounts and don't want to deal with the hassle or can't deal with the hassle of futures. We've seen this, with other products on the currency side, trying to create, currency options that were security, that essentially offered options on futures, but they were in securities accounts, and all sorts of other interesting attempts at this. A lot of them have withered and died on the vine for a variety of reasons. So again, not what they originally intended, but if that's what they can deliver, that might be an interesting thing in and of itself. It certainly sounds like that intrigues you, Mark.
Yeah, it does. It creates opportunity. And, the other piece is, with that weird financing charge, there's going to be some interesting trades, especially around kind of at the onset with people trading VXX versus this thing as well. I think there's going to be some it's going to correlate with VXX. And, when people will calculate what the cost is of holding VXX and will likely arbitrage the two against each other.
Yeah, that seems to be the play because VXX, obviously, the big player in the volatility ETF, ETP space. If you're going to arb one against something else, it's going to be VXX. So that'll be interesting to see how that shapes up. I should mention, by the way, listeners, we have reached out to the folks at AccuShares and Professor Whaley. They're going to be coming on the show in the recent upcoming episodes, so they'll have a chance to answer all these questions for us and kind of explain the evolution of the product and give us their perspective on why they made some of these choices and answer some of our questions about the product, because clearly there are quite a few. Speaking of questions, We might as well get to it now, Mark. I was going to save it for the listener mail, but it kind of dovetails into exactly what we're talking about now. So I'm going to elevate this question from the listener mail here, the Vol voicemail, and answer it now. This one comes from IVDaily. He or she writes, please explain the VIX Up and VIX Down products to me. I'm very confused. Well, you're not alone there, sir. He goes on to write, what am I getting if I buy this thing? It's not really spot VIX that I'm getting, but the actual percentage move in the spot VIX, correct? What does this period contract thing mean? Do I have to wait for someone to sell a VIX up before I can buy the VIX down and vice versa? Shed some more light into the darkness, please, guys. Well, that is our mantra here on Volatility Views, Mr. IVDaily or her. We do shed light into the darkness. He raises some good questions here, Mark. Some we touched on before, but I think they're worth repeating, re-answering, reiterating here on the show. I think a lot of people were confused about that second part, the period contract thing. I know Don brought that up on the last show. A lot of people thinking, I think, that these things are going to have equivalent volume numbers every day because you couldn't have a trade in one without a corresponding trade in the other. Clearly, from the numbers we're seeing these days, that's not the case. VIX up outperforming VIX down by about 1.5, 2 to 1, depending on the day that we're seeing that. So that clearly that is not the case out there. And in terms of the delivery of it, you're right. It's interesting because people think spot VIX is kind of something we talked about last episode. They think I'm just going to have this thing that moves in lockstep with it. But reality, what he's hitting on is actually more of the case. They're actually getting that percentage move in the basis as well. I'm sure you can see, Mark, how a lot of people would be confused by this product.
Yeah, it absolutely is confusing, and is just it's kind of a they went through so many iterations, it sounds like, of trying to figure out exactly what to do that I think it's certainly confusing to the average investor, and I'll be honest, probably a stay away from the average investor, at least until all the institutional people kind of hash it out and clear out all the easy arbitrage. And get this into and really once we sit down with Whaley, I think sitting down with Whaley will hopefully provide a lot of the answers that we're looking for. They may give us that, and that may be of value to us. So that I'm going to expect us when those guys come on. We're going to want answers from the AccuShares guys in terms of exactly what is it doing, what are they getting, and why is it trading X, Y, Z? And I think the last part, why is it tracking a future? I think I'm hoping they're gonna have an answer for.
Yeah, this thing, I'm looking forward to that show as well. Listeners, if you're stay tuned for that one because that's coming up and that should be pretty exciting. All these questions you have, I think, will bring up and hopefully a lot more. I've been digging into this, Mark, over the past week, looking at some of the prospectus things, and the more I dig into it, I can see why people are really confused about this. There's all sorts of weird things. I pulled up some interesting fun facts. You were talking about the fees before. There's all kinds of crazy distributions in this thing. People should know. People might be surprised. It doesn't really hold any vol-related securities in its account. It's all cash or essentially highly secure treasuries and things like that, fully collateralized repos. The distributions, it gets crazy with the distributions. At the end of the monthly cycle, the fund with gains distributes a regular distribution of a cash dividend or stock grant of equal numbers of VXUP or VXDN shares of equivalent cash value to holders of records. Distributions are the winning fund essentially gets to take a class share down to the losing fund's value. There's all kinds of formulas in the thing to explain how this works. It'd be hard to really convey that on the radio, listeners, but it's I encourage you, if you're interested in trading this, I think follow Mark's advice. Don't dive into it yet. Let it kind of shake out a little bit, but dive into this a bit because these redemptions and this one pays a dividend to that fund, which in turn goes to this one, but only if the VIX is below 30. If the VIX is above 30, it's a different scenario, and there's a lot of devil in the details here. So if you're going to dive into this, do your homework first. Mark, have you looked at this stuff at all? It's kind of crazy.
Yeah, I've been watching it. It's definitely, like I said, it's a VIX future. It is trading very similarly with a slightly different date. Very similar to a VIX future. So if you're saying to yourself, well, what's it kind of like? The answer is it's kind of like a VIX future. And and it's going to have similar characteristics, except for when things go crazy. And then, I need to see what it does when things go crazy. I don't think it's going to rally as much as people expect. I don't think or heck, it may rally more than people expect. I just don't know. And I need to see this and how the price action works on a day where we actually have a pop in VIX. Doesn't need to be to 30, but I want to see a day where the VIX is up a couple of handles, and I want to see how this thing moves. And until then, I would not even come close to this thing I wouldn't want to trade this as really anything. Probably wouldn't even want to try and arbitrage it.
One of my favorite parts about this is, as I mentioned, this thing was conceived as essentially a contango-less VIX or a VIX future. They realized somewhere in the development of this that wasn't really a possibility for them. They knew if they were delivering that, people would turn around and use their product to hedge their contango exposure, and essentially that would be a big hit for them. So they've actually built in essentially their own contango impact into this product with that 0.15% essentially fee, they're calling it, that comes up to an aggregate cumulative about 4.6% per month. That's their way of essentially building in that contango effect, so the market doesn't essentially come in and say, hey, we're going to thank you for hedging all of our contango exposure here on this trade. Still, it's amazing. All the ways this product has shaped up. Again, these are going to be great questions for the folks at AccuShares when they do come on, because this is not at all what was initially proposed. They certainly did not propose a product that had its own built-in, essentially, losses due to roll yield, and yet that's exactly what they have here. So a lot of interesting stuff. I'm looking forward to sinking my teeth into this a little bit more, but clearly the market is not playing a wait and see. Like we said, these things are just lighting it up, doing a lot more volume than anyone thought. VXUP doing about 70,000 today. VXDN, again, not trading period, so bear that in mind. The loser today, only about 15,000 today, which is interesting. On the day when the VIX is ostensibly down, VIX Down is only doing about 15,000 contracts. So perhaps not shaken up the way anybody thought, but still, there is that potential, despite all the questions we've raised. If they can indeed deliver some sort of securitized VIX future, essentially, that you can put in a securities account, that is an interesting prospect for a lot of people out there. Mark, let's shift gears here for a little bit. We were talking a lot about things, hitting lows. One of the things that hit a high recently was the put index over there. We talked about this before on the show, the PUT, the PutWrite index, CBOE does. In fact, we had Jason, the creator of that PutWrite index, on the show about a year ago to kind of explain some of the interesting nuances of that product and why it outperforms a thing like BXM, something you think would be fundamentally equivalent to it. They're both writing at the money SPX options. But you took that a little bit step farther recently, Mark. You sat down with our friend Russell Rhodes over there at the CBOE Options Institute, a friend of the program, and you did some other analysis, just kind of comparing it to something a lot of people probably already have in their accounts, kind of just buying and holding the SPX or the SPY or the S&P 500 itself, and compare that to just systemically writing those at the money or near out of the money puts, and how those two different approaches shaped up over time. And give us some of your findings that you guys discovered when putting together this white paper.
Option selling beats buy and hold. And PutWrite is better than BXY and is better than, was way better than BXM and was better than BXY. It is, it returns a nice beat on the S&P 500 with a standard deviation that's about 2/3, which is really nice. So I was extremely pleased with the results. And what we kind of found was, if you consistently sell puts, you were going to beat the market. And then, the other piece was that if you levered, you could basically match the volatility of the S&P and add something like 500 basis points, which, is a really nice win in my opinion.
Yeah, explain really quickly that levering, what approach you guys are taking to lever.
Yeah,
that.
well, the idea was someone could use portfolio margin and lever 130%, so nothing crazy. So really not even really delving into anywhere near a margin call, and sell 130% of the cash on hand and pull out an extremely nice result out of the sale of puts. Put selling is just an extremely effective form over time of making money. It is quintessentially selling insurance. And, there's a reason why State Farm and Prudential and, all these other huge insurance companies have massive, massive buildings and run all these commercials to get you to buy their insurance. And that's because it is profitable. And, the one piece I would kind of love to add in is maybe even doing more with what we do with the float. So the system, when you sell put, you use the balance to buy some of the market at the same time, so you get kind of some extra exposure, which is what the insurance companies do. So it was really interesting and quite just a great. We were super pleased, and if you want to read it, you can find it by just simply Googling option pit PutWrite, and and we wrote it. It's called a leveraged portfolio management approach using put, and it's the first thing to pop up. Yeah, on a 140% levered over a 26-year period, the S&P does 7.6%. The PutWrite does 11.2% and has a lower standard deviation. So the Sharpe ratio is just off the charts relative to the S&P, and that's what's so great about it.
But that probably flies in the face of what a lot of people would expect from a study like that, because the narrative has been for so long, writing puts is the most dangerous thing, and I'll do covered calls, I'll never touch a put. And the notion of systemically doing that month after month on the S&P with all the things we hear out there about black swans and everything else and how dangerous that is, I think a lot of people would assume that would essentially just lead to a blowout. And yet you guys are saying not only does it outperform total return, which I think blows a lot of people's minds, but also on a risk-adjusted basis, it pretty much wins on both fronts. So I think a lot of people might be taking a second look at PutWrites, and even the levered version you're talking about, with again returns a better data over. Again, you're not looking at like 2 years; you're looking at 26 years. So that includes 08 and all the other crazy periods.
The only thing we're missing is 87, really, in terms of all the major events. And I think kind of the interesting piece, and this was out of RMC, with low interest rates and with low interest rates and low and high skew, one can go out on a 1-year leap and sell a put 4% out of the money and buy an at the money call and do that for even money. So because so many people are using this as SPX as a hedge. And because using the SPX has become a worldwide hedge, it's been, I feel like this trade is actually getting better as opposed to worse. There are just not enough people to sell puts to all of the people that have these massive long portfolios that need to hedge. I mean, the whole world is long equity and needs to hedge. And there is a small slice of people that can actually sell it to them. And so when people ask, well, how is this possible? Is the world stupid? Is the world inefficient? No, but there's a supply and demand issue. There is too much demand to meet supply, which creates the edge, and that's that.
But Mark, I've never been able to turn down a nice bullish risk reversal. So if you have the chance to do that on the S&P on a levered basis and do it for essentially free or close to even, that's an attractive prospect, and that would have performed. That'd be a great iteration to your study. I guess they did it at RMC, but to see how that approaches. And speaking of that, Are you guys going to do? Is this a one and done, or
no?
Further
So
iterations?
we did a BXY one. We did this one. The next study to come out is going to be a merger of BXY and PUT. We're going to try and do it as kind of a wheel strategy. We've already got the results. I just need to really write it up. But that one, if you think that the PutWrite and or the BXY study that we did was interesting, wait until you see this wheel strategy of selling puts and buying and doing BXY in based on market signals, and it's incredibly compelling.
Uh-oh. The wheel. You're bringing in all my favorite hits here.
Mm-hmm.
No, what's next? The Iron Fly. Then you're pretty much done. Then you got all my favorites.
Yeah.
So when's that?
That's what I was thinking about.
When can we look forward to that one?
I think that's gonna probably be a July-August timeframe.
So look forward to that, and all you listeners out there who've been naysaying writing puts, this perhaps may give you some data to change that perception. And without further ado, I know we already filtered one up to the top, where we get so much great impact and feedback from you guys. We want to make sure you guys get your time in. So without further ado, it's time to dive right on into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, like the man said, this is the portion of the show where you guys get to take the reins and fire off your questions, comments for us. No shortage of ways for you guys to do all that. Just like our first questioner did here. This is from Jerry E. He writes, "Hola, fellows." Well, hola to you, Jerry. He goes on to write, "I like the programs, especially Option Block and Volatility Views." Well, thank you very much. He goes on to write, "I noticed you guys don't talk much about technicals. The few times you have mentioned them, you seem to take a dim view of them. Why is that? Are there no technicals that you feel are useful for options traders to pay attention to? What about volatility technicals?" Interesting question. I think it comes in. I'm going to separate that second part out for a second and talk about the first part first. I think that dim view of technicals probably originates from me. I've said that a few times on these programs and others, but I think, Mark, I don't put words in your mouth. I think you're not a big technical fan either. And I'll tell you exactly why I kind of had my interest, love, joy for, whatever you want to call it, technicals burned out of me at a very early age, just because people who may not realize that options traders, professionals, spend a lot of time slinging underlying to hedge. Particularly, we're talking about all these delta neutral hedges that we're doing, gamma scalping. That's how you make a lot of your money when you're an actual professional market maker. Particularly if you're long premium, you need to aggressively gamma scalp to make that decay back just in order to break even. You can imagine there's a lot of thought process that goes into that, a lot of analysis, a lot of fundamentals, a lot of technicals. And over the years, we, as well as I saw every other guy in my pit trying every other various way they could find to work out those gamma scalps and try to find those intraday swings in the underlying, because if you could work that out, you could do very well. And so there's a lot of effort put into this, all different systems. I tried a myriad myself in different ones of work your scalps here, work your scalps there, based on this system, based on that one. At the end of the day, what everyone kind of came to the same conclusion was that the ones that worked were the most widely followed. And it didn't matter if they had any relevance to the underlying or any relevance to anything else. So the low-hanging fruit stuff like Fibonacci and other things, they would work. And when I say work, I would say work in quotes. They worked a little bit, because what happened was there would be a massive aggregation of orders at those levels in the book, because everyone was using these same indicators. So the intraday fluctuations would kind of pause at those levels, maybe reverse, maybe pause and then keep going, but you'd see some impact on the underlying at those levels. And that was pretty much it. Every other systems, all the other systems we tried, that weren't the low-hanging fruit like a Bollinger, like a Fibonacci, things that anyone can get with a simple Google search and work their orders, nothing else really seemed to work that well. So it kind of, over time, I had a lot of that love burned out of me. That doesn't mean they're not valuable. I mean, again, we're looking at an intraday basis. Some technicals are more for longer term. I understand that, but that overall tended to really burn me on technicals. Mark, I know you got to have a similar viewpoint. Was that what happened to you as well? Did you have to did gamma scalping really rob you of any joy of technicals? Or are you still maybe a head and shoulders kind of guy, a candlestick chart guy?
Head and shoulders. No, the only head and shoulders I use is to keep my hair flake free. The really what I've spent a lot of time doing, I'll look at like moving averages or just kind of eyeball where I think support and resistance is, just based on kind of looking at a chart. But yeah, I mean, I've never been a huge believer in candles or, I feel like, there's an old saying that technical analysis works because people think technical analysis works.
Exactly.
And so, yeah,
exactly.
You do want the widely followed stuff that everybody's looking at, because the other little stuff just really doesn't work. And so that's always been the way I've approached stuff. It's not that I'm anti-technical analysis. It's just that there's absolutely zero secret sauce, in my opinion.
The second part of his question, I think, is interesting as well, because I have seen kind of a burgeoning area of research around this kind of what he calls volatility technicals, people trying to take traditional technical analysis approaches and trying to apply it to vol. and seeing if, because obviously vol is a different beast. It moves a different way. It trades a different way than the underlying in and of itself has its own kind of built-in inverse correlation. So there's a lot of things there that are moving pieces you have to factor in. But it is kind of an interesting area. I've kind of been watching it with the kind of his interest. I haven't seen anyone really develop, at least that I've seen, any good models for saying, hey, here's a good vol technical analysis chart, or here's some sort of pattern that I think works for vol. So the answer, at least for the near term, is no. Maybe some listeners have seen something cool and they could write in and send it to us. But it is an interesting idea. It's something I keep an eye on just to see what's going on out there. But I haven't seen anything. Mark, have you seen anything good in the area of technicals? You know, obviously our dim view technicals aside, technicals as it applies specifically to volatility. Anything that made you scratch your head and say, that's at least interesting theoretically.
All of the technical analysis I've seen on volatility has been dangerous and stupid.
How did I know you were going to say something just like that?
And I mean, seriously, last Friday, some guy's posting technicals on VXX, and I'm like, you realize you can't run technicals on VXX. Running technicals on a mean reverting product that can stay in different ranges for periods of time and explodes is just, it's impossible. There is zero use of technical analysis. Now, I'll tell you where you can call this technical analysis if you want, all right? A trade that I will look at is, hey, the VIX is somewhere near its low over the last year, and this underlying equity is below its low over the last year. That might be volatility premium I want to buy. If that is technical analysis, then call me guilty of technical analysis. But trying to actually trade specific vol levels in something like VIX or, even more stupid VXX or UVXY is just deadly. Speaking of UVXY, one thing we were remiss in mentioning was its beautiful 5-for-1 reverse split again this week.
Oh, yes, it's a big boy now. It's a big boy.
Yeah,
again.
It's back up to 38 for the next it's back above 30 for the next 2 months.
You got all these products that are just built in, inevitable downward
But they come out and
retreat.
say it. They come out and say it. It's fine. I have no issues with UVXY. I was saying this to a group of college kids today. I said, they come out and say what they do. All right. And it's not that the product is poorly structured. It's that the product is poorly structured for buying and holding. It is not poorly structured for taking advantage of a intraday vol spike or a multiple day vol spike. So just understand what you're dealing with.
I'm just looking here at the far out, longer term puts out here and how jacked these things must be.
Oh yeah,
it's a fait accompli that's going to happen. It's coming.
Well, the straddle in 2017, the at the money straddle cost more than the stock.
Yep, someone's lighting it up already. The Jan 2016 30 puts lighting it up this morning. So those are downside.
In my 401k, I was buying the Jan 2017 30 puts yesterday.
Someone's trading the Jan 2017 10 puts today.
The 10 puts, I see a 20 lot of the quarters.
That's a little extreme, but that might
you
work.
can see some of the 40s and 39s trading. No, you got to own that stuff because it's going to work.
The issues are that of just loading up on just tons. They own all the downside strikes out there in their personal account, just for their aunt does. My aunt Agnes, she loves downside puts in UVXY. Mm-hmm. All right, lest we besmirch another product issuer, let's move on really quick to another question here. This is the lengthy one actually, so we'll hit it really quick. The reason I want to hit on it, we touched on it. You may listeners, you may have heard a little bit on the Options Playbook radio show this week, but this is very vol-related question. I want to give him a couple of seconds on the vol show as well for all you guys that didn't hear it there. This comes from Ibrahim E.H. He writes, "Hi, Mark. This is Contrails again." That's a handle he's written in before on several times. "After several months away from options, I forayed into Forex." He goes on a little bit, directional trades, bullish bearing, and then not yet into the vol trading. "My question is, if I find a stock sitting on a strong support and at a very low implied volatility," he puts in parentheses, he's looking at Micron and P&G, "is what I'm looking at, along with confirming buying volume, would you buy an out of the money or an in the money calls? I have a feeling you will say, why not sell puts? But let's stick with calls for now, given my account restriction. Is there a golden rule on choosing in the money versus out of the money in this situation? I read that I only buy in the money calls because out of the money options expire worthless And he links to an article by Brian Overby, our host of the Option Playbook Radio, which is why we discussed it there on his top 10 mistakes of options trading. I encourage you to check that out if you want. He also goes on to ask, also my understanding is that when IV is very low, you would not buy a call vertical spread and instead choose to buy calls. Is this correct? Lastly, I have a question. Do leap options implied volatility increase at earnings times along with shorter expiration options? He squeezes one more in here. One more thing I forgot to ask. I'm looking to buy calls expiring in 2 to 3 months. I'm looking at daily candlestick charts. All right, this is an epic. I'm muting myself one more time. This is an epic one, Mark, but we can squeeze it in for a few minutes. I'll forego myself because I already had a chance to kind of discuss this question on another show, but you haven't had a chance to dig into it. And it's also right in your wheelhouse. I know you've been talking a lot lately about the decay of out of the money versus in the money calls. So this is kind of right up your alley. What do you have to say to our friend here, Mr. Ibrahim, who's looking at verticals versus at the money calls and which way he should go depending on the vol?
Well, yeah, and that's just it. It is depending on the volatility. When volatility is at its lows, real lows, I'm a big proponent of buying calls. But when volatility is high or middling, anywhere in the normal range, you have to spread because otherwise you're just going to eat a pound and a half of decay. And in fact, if volatility is anywhere from to kind of normal to above normal, I even lean towards selling premium to get long as opposed to buying premium. The only time I really like to buy premium is as a straight trending stock with just when I see dirt cheap implied volatility. If I don't see that, I'm not really interested in kind of the balance of it. They don't do me a lot of good. Now, in terms of daily candlesticks, I'm not a lot. Here's what I would say. I think a lot of people look at daily candlesticks, which makes it, potentially a good thing to use. And then but merge those daily candlesticks with some volatility analysis, and you're going to be a happy camper.
Yeah, he mentions he thought we would say sell puts, so he can't do that. But yeah, you're very rarely going to hear us, Ibrahim, or anybody out there say just go out and buy premium willy-nilly. We're always going to recommend usually some sort of spread leg to offset it. That's just a smarter way to go.
Or just good vol analysis. I'll buy calls if the volatility is crazy cheap. On my blog right now, I wrote a blog in MasterCard. All right. So here we are. The VIX is near its year low. MasterCard is below its 52-week low implied volatility. And it's out of the money. And you look and you say, okay, I can buy an out of the money call in a $93 stock, $2 out of the money for $1.40. You just think there and go, okay, I will buy that call. All right. Now, if that call is $5, $6, well, then guess what? I'm going to buy the 95. I'm going to sell the 105 and put on a favorable spread, or I'll even do a butterfly. But so add that volatility analysis in. That is the key.
He also has that question about leaps, implied vol. I'll say really quickly, a lot of people conflate the fact that leaps have a lot of vega. They're very sensitive to volatility with the notion that they're going to move around like a front month when it comes to vol. At earnings times, he mentions, you think about it, if you see an Apple or something else like that, and they have some big announcement, and their earnings is coming up this front month, you're going to see a lot of vol increase. We talked about that many times on this show in that front month. And maybe to a degree in some of the surrounding products, but not much. If they're past the earnings amount, you're not really going to see a lot of that in there. Certainly, if Apple earnings are right now, and you're looking at a DEAS 2017 call, you're not going to see a corresponding big bump in implied vol just based on the impending announcement. If there's some big development after the announcement and the stock's cut in half or something huge happens, that call is going to respond, has a high vega component, so a small move in volatility will impact that option. But you're not going to see it, moving commensurately with the front month. If the front month goes from a 20 vol to a 40 vol, the DEAS 2017 is certainly not going to do that. So don't look for those kind of moves when you're trading those leap options. It's much more of a minute beast when it comes to that. Great questions, everybody. Fortunately, it's time for us to keep on rolling into our final segment. It's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, you guys know the drill. This is the portion of the show where we prognosticate recklessly, this time into the teeth of the oncoming holiday weekend here in the States. Mark, we were talking a little bit at the top of the show about how maybe it might be a decent time to certainly not sell vol, but maybe if you want to get some over the weekend, maybe. But then you were speculating that maybe with the futures where they are, perhaps we won't get that corresponding Tuesday morning pop that we always get after a long holiday weekend or even a regular weekend, in which case maybe that buy may not be the best thing. Are you still holding on to that here?
Yeah, I mean, take a look. I mean, VIX is 12. VIX June is 1430. You know, I don't know that we're going to get a big pop. I mean, I'd rather, if someone come up to me and said, you have to either buy an at-the-money straddle today or sell it and unwind it on Monday morning, or Tuesday morning, I'd probably buy the straddle here. I don't think it costs me very much. I'm certainly not going to collect some decay. But, they're not pricing this stuff like there's going to be a big pop on Monday.
Nice thing about the futures, you always kind of have at least an indicator of where things are heading. And we'll see if the AccuShares folks can replicate that well in their product. And, of course, we'll dig into that more on future shows. But, unfortunately, that's all the time we have for the Crystal Ball segments. Also, all the time we have for this episode of Volatility Views. But before we go, as always, let me check in with my cohort here on the Volatility Views panel. See what he's cooking up that may interest you. Mark, I know you guys have myriad different things launching out there in the volatility space, webinars and events and things like that. So what are you cooking up that may interest our listeners here on the old Vol Views program?
We got the Option Pit Boot Camp starting on June. Let me double check the date. It's June 9th. It's going to be Tuesday, June 9th, Wednesday, June 10th, Thursday, June 11th, and then Saturday the 13th in the morning. So all told, it's somewhere around 9 hours of education. The normal going price is either, between $395 and $495. I'm offering at $247. Go to optionpit.com/bootcamp to sign up. And, if you take the course and you hate it, I'll give you your money back, but you won't.
There you go, listeners. Money back guarantee. And Mark doesn't do that very often. Pretty tight with his money, so take that.
Well, pot kettle.
So if he'll give you your money back and he's offering that means he's standing behind his stuff. So go check it out over there at optionpit.com to learn more. We like to hear that from people who offer educational stuff or anything in the space that they offer. They stand behind their work. Those are the kind of people we like to partner with here, not those guys out there, pay me $10,000 tomorrow and then I'm just going to head to Bermuda. None of that here on the old network. And on behalf of Mark and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And, of course, for sending in such great questions. Keep those coming. We love to hear from you guys. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.